Okay, welcome everyone to today's webinar. Great, welcome everyone to today's webinar. We're gonna get started in just another minute or two. So in the meantime, I encourage you guys to run around the block, get a glass of cold water, grab a coffee, check out some interesting articles on payments.com, and we'll get started in just another minute or two. Okay, so we're going to get started now. Thank you, everyone, for attending this morning, afternoon, evening. My name is Ari, and I'm your host and moderator for today's webinar, where we'll be discussing out of wallet, out of mind, the critical role of digital wallets in consumer lending. Before we get started, just want to highlight a couple of admin items. So you'll see on the bottom of your screen a Q&A button. That is where you can go and post any questions that you might have. We'll try to get to as many questions as we can from the audience twice during the webinar, so feel free to start typing the questions right away. During the webinar itself, so we will try to answer as many questions as we can, but don't worry, if we don't for any reason get to your question, we will respond to it and follow up directly to you by email within the coming days. And last but not least, we will be recording the session today. So after the webinar, we will be sending each and every one of you a recorded version of the webinar, and we'll also make it available on our website in the coming days as well. So that's from an admin standpoint. So let's dive in. And again, I think we have a very exciting and timely topic today. The topic of digital wallets that has not only been all over the news, but it's really quickly changing the very foundations of how each and every one of us goes about our daily lives. So we have the great fortune today to be joined by Jiffity's CEO and co-founder, Yaacov Martin. Some of you may have seen or heard Yaacov on stage or in podcasts or in different articles all over the place. Yaacov is really a thought leader around all things fintech, with a particular passion for all things embedded finance, embedded lending. And Yaacov and the Jiffity team have extensive experience with really this whole area around wallets now, helping banks, merchants, tech partners deploy impactful solutions to meet the dynamic needs of this market. So I think this will be very, very interesting for all of us. And just as a reminder, the session today will be delivered from a purely educational perspective. So no sales or anything of the kind, purely from an educational standpoint to really learn and enrich this important area. So what's on the agenda for today? Well, we're going to start actually by briefly going back in time a little bit to discuss some of the challenges at play when there wasn't an awesome frictionless vehicle to facilitate payments so smoothly. I think this will give us actually a good context and springboard for the conversation around technology that's really been developed to empower people, customers, to procure products and services to help make a difference in their own lives. And then we'll talk about the wallet itself. So what is it? What is a digital wallet? How does it work? How does this technology enable customers to have more control and be more deliberate in how they buy products and services? We'll then pause for a few minutes to address some questions. So again, as a reminder, the Q&A button on the bottom is where you can put any and all questions that you may have. We'll try to get to a few of them at that point. We'll then dive back into Yaacov, really presenting from a macro standpoint the market itself, and talk about consumer adoption, e-commerce channel, point of sale channel, and look at that from an Apple Pay, Google Pay, and geographic standpoint as well. Then we'll, and I know this sounds like a lot, but I think we will have enough time to get through it. I promise. We've rehearsed a time or two. We will then talk about Apple Pay in particular. And for those of you that may remember, a few months ago, Apple actually had an announcement regarding its Apple Pay Later product, and some new innovation really around Apple's embrace of bank partnerships to offer installment options in the wallet. And so we'll go back a little bit around Apple and what that means for the landscape as a whole, and the landscape in particular for partnerships and banks in the wallet. And then finally, we'll talk about kind of what's next, some of the future initiatives that banks have in this area, and in particular as well, B2B, and some of the use cases and angles that we've heard about for wallet expansion for small business lending as well. So I think that's, we've got a lot in store for us. And if we have time, we'll also touch on some success stories from some of our own experiences working in this space with banks, merchants, and end customers around the wallet. So we'll then have questions to wrap things up. And as I said, we will try to get to as many questions as we can. But if not, we will also address your questions directly by email after the webinar. So, so there we go. So why don't we get started? Yaacov, if you're ready, I'm happy to hand the reins over to you.
Ari, thank you. Thank you for that wonderful introduction. With the, I would say, risk of me starting this webinar with a bit of a swelled head. So keep it humble next time. I wanted to actually start off by just saying how exciting it is to speak, although it's not as interactive as it is when we meet in person. But I did review some of the list of registrants for this webinar, and it's extensive, and it's wonderful to see so many familiar names. Some are really a blast from the past. So great to have you all on here, and hopefully this reignites some of those wonderful conversations that we have been having and had in the past as well. And for those of you who are in constant contact, this is another great way to share thoughts, ideas, and information in general. And before we start, excuse us for all these introductions. I just really feel obligated to start with some gratitude. I wanted to thank so many people who were involved with setting this up. Jiffany's marketing team, it is incredible to see what you guys pull off time and time again. The idea of me being able to walk into a room and know that everything has been attended to from the largest to the smallest detail is something that I've become accustomed to and never take it for granted. So thank you, Jiffany Marketing. And now that we've completed all of our introductions, I'd love to jump right into some of the content that we're going to discuss today and share some of our observations that we've had over the last few years, and maybe more specifically over the last few months with the advancements and various changes that we've seen in this ever-changing market. Ari has definitely noted some of those before. So let's start with bridging the gap. When we say bridge the gap in this context, we're actually referring to two gaps. We're referring to the overall gap that, in my mind, consumer lending is meant to bridge. Essentially, in any type of consumer lending setting, we are trying to cater to an end user. This can be a consumer, this can be any other type of customer who's contemplating a financial transaction, and there is a gap. There is a gap between the transaction that they are looking to complete and their ability to complete it in terms of the cash on hand. And this doesn't matter at the moment as to whether or not they have some sort of means. It means that at the time, at this point of need, there is a certain gap that needs to be catered to. And the entire thesis for consumer lending, and specifically embedded lending, is how we can bridge that gap. How can we bring the supply? How can we bring the right product to the point where it is needed most at the time that it is needed by the customer or consumer that is looking to, as I said before, complete this transaction? That's the essential gap that we're looking to bridge. But there's another element of gap that we are going to discuss extensively in the next 45 minutes that we have, and that is the technological gap or the operational gap, the integration gap, that we essentially are looking to bring different parties that supply or provide different services. We're looking to bring them all together in real time and perform this type of seamless magic that is going to bridge the previous gap that I mentioned before, that any type of end user may be experiencing at the point of transaction. So in order to highlight what that gap looks like or looked like, I'd actually like to focus on an in-store transaction without digital wallets involved. This is basically trying to take you or time travel with you into a situation not long ago where we and other players in our industry and other providers in our industry, banks, lenders, et cetera, looked to make various financial products available. And again, for the sake of this example, at the point of sale in store. And the reason I look to focus on this example at the moment is because, to a certain degree, it really takes us into an area where I count, I think, the greatest number of challenges that existed in the context of integration, and even from a customer experience perspective. Essentially, without a digital wallet, we struggled with bringing a bank that may be sitting on one side of the country, bringing their product, making it available, making it noticeable, bringing it so that it could be discovered by a customer. And again, right now, it doesn't really matter whether we're speaking about a consumer or maybe a representative of a business that is looking to complete a business transaction, a high value transaction within the realm of a brick and mortar shopping experience. So the discovery of the fact that there is even such an option of finance or a financial instrument being made available to this end user was a challenge in and of itself. But the challenge only begins there, because everything else that followed seemed to present its challenge. And I'm going to now list a whole bunch of different challenges that we saw our partners experience in the way that consumer lending or point of sale financing, whatever you would like to call it, within the realm of a physical shopping experience presented itself. So we spoke a little bit about the discovery. When and where does the customer actually discover that there is this financial product, may it be an installment loan, a revolving line of credit, a buy now, pay later, which in our lingo usually means a split pay, a deferred payment? Where do these options exist? Where do they live? Where do they meet the customer? So that discovery and awareness was a real challenge in stores. Obviously, many networks of or many different brands decided to use signage. And signage was good to a certain degree because it at least informed the customer that there will be some sort of opportunity at some point in time within the shopping experience to hopefully apply for whatever financial product was being offered. The problem was that this awareness may have come to fruition at the beginning of the shopping experience, but the customer had absolutely no idea what they would or wouldn't qualify for. And therefore, they had no idea as to what their purchase power may or may not be. So imagine going through an entire shopping experience, knowing that maybe you'll be able to apply for some kind of financial loan program, but you still do not know as to what you actually will be approved to utilize or not. So in this type of context, essentially, customers had to go through that entire shopping experience. Just imagine to yourself, they're piling up their cart. And then finally, they line up or queue up, as some of our markets like to say, at checkout. And when they finally get to the front of the line, they would like to apply for this financial program, for this loan, for this installment plan. At that point, they find themselves in a position where they need usually to ask for the opportunity to apply, and they have to start divulging or giving over much of their highly protected or confidential information, including obviously their annual income and other types of personal details. That in and of itself was often considered to be a very unpleasant type of experience that customers had to go through. So much so, in fact, that many chose not to go through that experience for fear of decline, for fear of rejection. Now, at this point, I've already taken for granted the fact that this application process, or maybe digital form, was pre-installed. It was pre-integrated into some form of point of sale or other terminal. And that, of course, required certain training of personnel or coworkers on the floor to know that they actually can offer this type of product, can process such an application, can assist the customer in presenting those details and hopefully getting approved for that loan product. And then, of course, that integration also required the ability to transfer the funds or close out the transaction if and when that application process was successful and those funds were approved. And then finally, and this is really post-transaction, one of the major challenges was you may be approved up to a certain amount, and that provider, that bank, that financial institution that is backing that loan now wants to optimize the utilization of the credit that was already granted. All of these challenges presented a very low conversion, a very complicated, long, and often expensive process of bringing to life an actual point-of-sale, consumer lending, embedded lending product in a physical store. Now, outside of a physical store, there were plenty of challenges as well. I specifically highlighted this type of experience because I really do think that every single one of us can identify with that type of shopping experience and immediately understand why each and every one of those steps presented a challenge, either psychologically to the customer, from an operational standpoint for the merchant and or the bank or financial institution behind the loan, and of course, many of those other integrations that were required and the time to market for all the players involved. In an online type of setting, then of course, there is greater engagement with the customer throughout the shopping experience if you're collecting various digital footprint type of information. So there are certain things that can be mitigated. Nevertheless, in many cases, again, the qualifying portion takes place at the very, very end, and the integration that is needed, while not as extensive as the integration that is required in store, still exists and still requires many different parties, such as gateways and acquirers, et cetera, to take a part in setting up these types of financial products in an online setting as well. That has all changed. And that is really the point that I am going to spend most of my time on explaining how it's already changed through the wallet and what is still installed, what we can look forward to optimizing and further advancing with many of these options opening up to us all as a collective in facilitating and enabling and providing the right types of financial instruments to customers when and where they matter most. So before we get into all the details of how the wallet can solve so many of those challenges that I noted before, I'll share with you that in our experience at Jiffity, these in-store and online, but primarily in-store challenges, presented themselves to us when we really started out, when we embarked on this journey of enabling embedded lending. The issue was that wallet, as we know it today, and as prevalent as it is today, did not really exist in its entirety at that point in time. But funnily enough, we looked to some of those core ingredients that exist today in wallets in order to solve many of the challenges that we presented beforehand in the form of a virtual card. So in other words, if you think about the entire experience that I described before, I'm going to now turn it on its head and describe to you, hopefully briefly, how we set out at the time to solve many of the challenges, which challenges still remained, and how those got solved by the fact that wallets have really become so popular, and more specifically, recently, as wallets, so to speak, opened their gates for third-party providers. So if we are to tackle that type of difficult shopping experience where a customer, number one, doesn't always have the awareness, meaning the discovery isn't always there. Even when it is there, they don't really know if they qualify or if they may be rejected or declined. The lack of discretion, meaning the fact that they were forced to actually share their details and had this fear of being rejected. Many of our partners have estimated that approximately 30% of their customers who needed these types of solutions in order to complete transactions didn't want to have to go through that type of experience for fear of rejection or fear of decline. And therefore, we took this entire experience and really tore it apart and said, how about if we could have that entire application process take place at the very beginning of the shopping experience, or maybe even before they set foot in the store? What would happen if we were able to allow for customers to apply in a discreet manner, in a manner where they did not have to speak to anyone? They could do this in privacy, and whether or not they were approved for the loan would be only their business. Furthermore, how can we do this in a way where we provide them, assuming they are approved for this loan program, whatever that loan program may be, with the instrument that ultimately will allow them to transact and check out seamlessly, just like any other shopper who may not be in the need for an external financial product to complete the transaction. And what we actually did was we introduced a very simple application form that any customer in the store would be able to access through their own mobile phone by scanning a QR code, et cetera, et cetera. But the real change took place in the fact that once we collected that information through an application form on their own mobile device that they were able to fill in whenever and however they wanted, that was, of course, ported to the bank or financial institution that we were serving on the back end. They were providing the underwriting, they were providing the balance sheet, and we were able, together with them, to render an immediate credit decision, of course, but furthermore, if they were approved, provide a virtual card immediately to the customer so that they then had that in their pocket and they could ultimately, when they finished their shopping experience, knowing exactly how much they could afford, they could utilize in order to check out. The problem remained, and that was that they were holding a virtual card. Not every point of sale, not every terminal, not every coworker or staff member knew how to process that virtual card. Furthermore, there were certain types of configurations that sometimes had to be done on the systems in order to accept a virtual card, for example, through a key-in methodology. Well, once wallets opened up and became available to us, we were able to take that virtual card, provision it to the wallet, and the customer would simply be able to tap out and check out like any other customer on the floor. And what that basically means is that we were able to turn the experience on its head, provide the utmost discretion that any applicant may look for, seamlessly allow them to check out, knowing exactly what their purchase power is, and avoid any type of integration into those third and fourth party, I call them, systems of the merchants or service providers or clinics. In a moment, I'll like to expand on who this really caters to and who this applies to. And of course, eliminate any need whatsoever for changes in the business as usual function of the merchant, the service provider, the staff they have, et cetera, et cetera. That's what wallets have done from an operational and functional standpoint. They've allowed us to streamline the entire experience, regardless of where the customer is. Of course, this applies not only to an in-store transaction. This applies to a visit to a clinic where you need a financial instrument or a loan in order to go for an elective medical procedure, or apply for furthering your education, or transacting on some sort of other service. And not only in a brick and mortar setting, this is true for online as well. Although, as I mentioned before, the brick and mortar setting definitely had many, many more challenges in terms of a customer experience. So from an operational and functional standpoint, wallets have changed our lives. They've made all of these types of transactions seamless and agnostic in a way to the placement of the offering and to the place where this transaction is completed. What we haven't done yet is spoken about how wallets completely impact the market as a market, the distribution as distribution, the reach that we have, etc. But we'll touch on that in just a few moments after we pause for me to take a drink and for you to be able to send over any questions that you may have.
Right. And so while you pause, Yaacov, let me dive into one of I think the best questions that we have so far, really a lot of good ones. But Mark asked in particular, there was a popular article from FinTech Brain Food regarding the wallet being the consumer's center of gravity. And so Mark was curious to understand, we've touched on kind of the transactional operational aspects of a wallet and vis-a-vis payments, but what is your take kind of on the larger play of a wallet and being a consumer's center of gravity? Like, what else can exist in the wallet? What other types of life events, or basically, management of beyond just payments, although payments obviously being huge, but in the sense of it being a center of gravity as well?
Right. So first of all, I have to say that I recommend to anyone who has anything to do with wallets to read this article. It is just in terms of summarizing many of the aspects and elements that wallets provide today. I think it's an excellent overview, an excellent summary. Maybe we'll send that link out together with some of the materials that we can send out post-webinar. So it is absolutely true that, and specifically in this article, I believe Simon goes a lot further in describing how wallets are impacting not only our transactional life, but how they hold the key to our entire digital identity. And in that article, there's quite a bit of time spent on the actual owner, so to speak, of the wallet itself. So that means the wallet holds, just like any other physical wallet, holds many different functional pieces. For example, transactions, but not only ID verification, tickets, et cetera, et cetera. So I would say that the ownership of the wallet is probably a bit out of scope. But what I will say is that indeed, a wallet today serves more than only a method of transaction or an instrument for transaction. And the interesting thing is that wallets more and more really do control our digital identity and allow us to leverage and utilize our digital identity in a very seamless manner. Now, identity management ties in directly to some of the financial products that we are focused on, because of course, the financial products that we are focused on include an underwriting process. That underwriting process has a lot to do with with one's identity, and in this case, digital identity, and the way that those two can play into each other. So think about this. You have a wallet that not only allows you to transact, it in and of itself is what allows you to actually apply and get the approval you need from an underwriting perspective, from a KYC perspective, from a digital identity perspective, in order to enable essentially the lender to approve your application. So there's definitely more to it. And we are going to at least refer to the wallet as a means of distribution. And obviously, the fact that wallets have become so popular and prevalent have much to do with the multi-functions that they serve.
Okay, great. And I'm going to combine two questions, actually, one from Richard and one from Michael. I think these are complementary. So the first is, we've talked about different types of financial products, but we talked about payments, but we talked about different types of loan programs. So you mentioned installment loans, lines of credit, et cetera. So just wanted to verify if a wallet can really house that kind of full gamut of loan programs or financial offerings. And then to the second part of that question from Michael, really is asking, are there any restrictions in terms of amounts, in terms of which types of programs, which types of financial institutions, et cetera, et cetera. So we're like, as this is a very new kind of area, what kinds of programs can really be offered from a financial product standpoint, and as well as transaction amounts, product types, et cetera.
Right. And you're right for combining those two questions, because they obviously play hand in hand. So it is true that wallets in certain cases still do have certain limitations. So the number one thing that I can say is we've seen this trajectory. Those limitations are constantly either being removed or modified. And as you mentioned before, the more the wallets become the center of gravity, so to speak, we find many of those caps or restrictions being removed and lifted. So with time, I think many of these limitations or restrictions are going to, I don't want to say disappear, but definitely become a whole lot more flexible. Even today, with some of those restrictions in place, knowing how to issue, knowing how to provision, knowing how to structure that loan product or financial product and place it on a card that is stored in the wallet allows for a much greater level of flexibility, but the know-how has to be there, the capabilities of different types of issuances, different types of cards, and other types of limitations on the spend can alleviate, for example, the limitation on amount. And those are things that we actually are very heavily involved in because, as maybe many of you know, Jiffity concentrates primarily on the larger ticket type of transactions. We are involved as well in buy now, pay later, or pay in 3, pay in 4, but I would say the vast majority of our portfolio is usually revolving lines of credit, installment loans, deferred payment, B2Bs, unsecured but also secured. And we needed with time to figure out how we can maximize the capacity of the wallet to hold these different types of transaction or different types of loan programs, just to make sure that I'm crystal clear for those who are kind of hearing about this, maybe not for the first time, but with less background. We view the wallet in this context as an instrument to complete the transaction, right? The application for whatever product or origination of the product can take place separately and needs to take place often separately. But then the way to transact, the ability to transact immediately and seamlessly, is facilitated through the wallet that carries those funds that have been approved.
Right. Yeah. So let me just ask one last question, I guess, for this part, and then we'll carry on with the presentation. I think these are also two connected questions. So Steve is asking if customers really get a choice from who they actually will end up borrowing from, and do they care? And I think that's an interesting question, because it touches as well on what is the interplay, and this is a question from Tabudi, regarding actually the banks or the financial institutions and Apple Pay and Google Pay. So really, what is the interplay ultimately between the, I guess, vehicles of Apple and Google, and then smaller providers as well, versus or complementary to the banks themselves? And how does that then get messaged to the end customer? On the one hand, that they're living in a specific wallet vehicle. On the other hand, they will have a product coming from a bank or from another fintech lender or other type of financial institution.
Okay, so I'm going to try to tackle these one by one. So the first question with regard to whether or not the customer or consumer really cares who they're borrowing from, we have definitely seen a much greater level of awareness over the last few years. So I think in the heyday of buy now, pay later, this is probably in between 2018 all the way to the end of about 2021, those were kind of the it was the golden era for buy now, pay later, all of a sudden exploded, and accessibility was really key. So if you were checking out online and you had all these options of splitting the payment, this was exciting. It was new. It was needed. And there was, I think, a little bit less discretion. With time, as customers started using these types of methods and understood sometimes an associated cost, fees, et cetera, as well as the regulator, of course, probing some of these products and this getting headlines, I think customers were a bit more educated and started understanding that there are consequences to where you're getting credit from and who you're borrowing from. And therefore, the answer is today a resounding yes, especially in high ticket values. Sorry about that. Didn't click over to the questions. But customers and consumers, when they're going for a meaningful transaction and have to apply for credit, those rates are incredibly important to them. And sometimes their trust in an institution really depends on their level of familiarity with the institution. If it's a brand that they recognize, a bank brand, maybe a bank that they bank with, yeah, these things are becoming increasingly important to consumers and other customers who are non-consumers as well. With regard to the second question, most of that I'm hoping to tackle in the next section of the webinar, meaning speak about the democratization that is taking place in wallets, meaning whether or not a wallet needs or is or was tied to a certain provider, sometimes the provider of the wallet itself. We'll touch on all of that, hopefully, as we continue on with this webinar. Okay, so with that said, let's now go on. So we've kind of tackled the functional and operational role of the wallet within consumer lending, embedded lending, highlighting it with the example of an in-store, in-clinic, or in-person transaction. And what we're going to do now is going to really be speaking in a broader context of the wallet's position in the market and how that can impact many of us who are involved in one way or another in providing consumer finance or consumer lending out there. So the stats that you see in front of you may be known to some. I find them truly incredible every single time I review them. The level of penetration of wallets throughout not only the US, but globally is staggering. And I think that when you look at the history of finance and payments, it is difficult to find such a revolution that took place in a relatively short time frame. I mean, the fact that today we don't blink when people transact without leaving their home with their wallets, with their physical wallets, and rely entirely on their mobile device means that they have also come to expect the fact that essentially every merchant or other type of service provider is set up to accept a transaction that originates from a wallet. So I think that is, in general, a piece of data or pieces of data that cannot be ignored. More specifically, if we really zoom into some of the major providers, and let's not kid ourselves, when we speak about Apple Pay and Google Pay, they definitely are leading the market. Although, as I already mentioned before, there are definitely other providers in many markets, including the US, that have market share. But Apple Pay users globally at 500 million means that not only have they been able to penetrate or become popular, like a popular app that has all of a sudden gained tens or hundreds of millions of users. These are not eyeballs. These are customers who are transacting. That means there's a dollar value attached to the penetration, the massive penetration of these wallets. And the fact that 30% of global point of sale spend is already being facilitated by wallets is another piece of information that cannot be ignored by anyone playing a part. If we look at the triangle of banks, lenders, financial institutions as the supply, the demand that is created at the point of sale, whether that be a merchant in retail, a service provider, et cetera, And finally, the end customer, if 30% of all transactions at point of sale are being facilitated by wallets today, I think everybody involved has to figure out how they play ball, how they take part in this unbelievable revolution that has taken place in terms of how customers pay. And in order to do that, I'm going to take another step back, and I'm going to zoom out again and really discuss the various players, or even I would say particles within the market of consumer lending. So at the very top, you see two categories that I think are self-explanatory, right? We speak about banks and lenders on the one side. Those are entities that we often partner with and we serve. And in a moment, I'll describe how that is done and who that is done by. But the banks and the lenders are essentially, in our lingo, the supply. They can provide the balance sheet. They can provide the underwriting for various financial products. And they are obviously a crucial player and component, having the mandate to take that balance sheet and distribute that balance sheet as long as it conforms with their guidelines, their policies, their underwriting, their risk, et cetera, et cetera. On the right-hand side on top, we have merchants. Merchants is really code name in this context. And we use it because it is, again, self-explanatory, but a merchant is not only in the world of retail, it is any place where there is a service or goods being provided. It's the place where the transaction takes place. On the bottom left, we're looking at the wallet providers. We named the primary ones just a few moments ago, and they are a standalone component that exists today and is obviously critical for the seamlessness and other aspects of consumer lending. We have the financial services companies, and financial services companies are important to note here because they provide services both to the banks and lenders and financial institutions on the one hand, the supply, but they also provide many services to merchants or to the place where the transaction is taking place. So to banks and lenders and financial institutions, they may be providing various core banking components such as underwriting and servicing, et cetera, et cetera. And to merchants and other service providers who are accepting payment, they are enabling the acceptance of that very payment in the form of acquirers and processors, et cetera, et cetera. And then finally, on the bottom right, we have embedders. And we, of course, see embedders as another function because Jiffity, in a sense, that's the experience that we have as embedding, bringing together many of these components that you see on the screen here and allowing for all of them to really act in unison, in real time, and provide ultimately that seamless experience both for the customer, but also for those merchants or other service providers who are looking to make the most appropriate financial product available when and where it matters most. And in other sessions, we spoke at length about the importance of matching up the financial instrument to the contemplated transaction. You want to make sure that both in terms of the duration, in terms of the terms, in terms of the limits, that financial product is really catering to the transaction that is being contemplated by the customer that is contemplating that transaction. So now that we've zoomed out and we understand who's who in the zoo, we can move on to understand the latest developments with regard to wallets. And here we're going to use Apple Pay as an example. Again, just like I used the physical shopping experience in store as an extreme example because it served the purpose of clarifying the change, so too with regard to Apple Pay. Apple announced long ago, over a year ago, the launch of their Apple Pay Later. And the interesting thing about that was that I read plenty of articles and spoke to many, many colleagues who at the time thought that it was essentially game over. If Apple Pay is launching an Apple Pay Later, then all other buy now, pay laters are essentially going to evaporate because Apple Pay already then had such incredible market share. And if they themselves are going to build in a mechanism that allows to finance or allow to split payment within their Apple Pay, there's really no need for anybody else. The interesting thing, of course, was that it didn't take very long, only less than a year, for Apple to then announce, after a long-awaited launch, that they are shutting down Apple Pay Later. And that announcement, I think, came as a surprise to some, wasn't a surprise to others. And I think we'll understand why in just a moment, because together with that announcement came another pretty incredible change. And that was that although Apple Pay Later as a brand, as a function built into the Apple Pay provider, being Apple, was shut down, very soon after, lenders were in. In other words, the Apple Pay function opened itself to having other lenders and players offer various types of products through the Apple Pay mechanism. And actually, in a way, this is exactly what we're speaking about in the context of enabling consumer lending as an embedded function at any point of sale through the democratization of the wallet as it comes to these types of financial instruments riding on top or on the rails of the wallets. So it's really two sides of the same coin. Now, some of this may seem obvious in hindsight, but as I mentioned before, the initial announcement of Apple Pay Later seemed like doomsday. And once they shut it down and brought other independent lenders in and opened it up essentially to any player, and this touches a little bit on some of the questions that were asked previously, we today assist and enable many of our partners to offer their products in facilitation through Apple Pay. Yes, there is work of embedding that has to be done. Obviously, the origination is separate, but even in terms of the provisioning of those funds to a card that sits in the wallet has to go through certification. It has to be built and configured in a certain way. It needs to fit some of those limitations that were mentioned previously in the questions section. And sometimes those limits can be lifted if, as I mentioned before, the card is configured in the right way and certified in the right way. But in short, all of a sudden, this has become an option. And once that wallet accessibility becomes an option, then that entire challenge of in-store or integration, even online, of course, because as we know, Apple Pay is becoming popular for online transactions as well as Google Pay. All of those integration barriers, all of those, in a sense, distribution and experience barriers can go away. And they go away without having to educate the customer. The customer transacts in the same way that they are always used to, even when they are not doing this on the back of a financial loan or product, as well as the service provider, the merchant, the retailer, where they don't have to further integrate. As long as they're accepting wallet payments, we're able to facilitate virtually any type of financial method, financial product, loan program, buy now, pay later on the rails of the wallets. And this evolution, as you can see, both in terms of wallet payments and wallet transactions, as well as the time that it took, so to speak, for Apple to understand their strategy, is mind-boggling. Announcing a launch of Apple Pay Later, quickly shutting it down, but bringing in or democratizing the platform, bringing in banks and other lenders and other partners to offer this. It is not restricted. It is not restricted to one type of lender or another. As I mentioned before, we are constantly engaged, and as we speak, have multiple projects where the provisioning is done through the wallet to allow for the transaction to flow through. So now what? Now that we understand that this is possible, now that we understand the prevalence of wallets, now that we understand the ability to really seamlessly effect these types of transactions and financial products at point of sale, what's next? How should we be thinking about it if we're sitting in the seat of the banks and the lenders and the financial institutions who are looking to provide these type of products to the public? How should we be thinking about it if we are merchants looking to enable our customers to transact? And how should we be thinking about it even as technology players who are looking to optimize these type of processes, who are looking to grow market share for our partners or with our partners? So one of the aspects that we see and we believe will continue to grow has to do with one of the questions asked previously, and that is choice. The choice that now customers have and merchants have in terms of who they're partnering with. So as we all know, for many of the fintech buy now, pay later players, the last few years really were the golden era, or up until at least a couple of years ago, where things became a little bit tighter, both financially and from a regulatory standpoint. But they were really the ones who proved to the world that this is a market to be had. This is a scalable market. And if you build it properly, it can be accessed by the masses. It'll become to be expected, and it really democratizes the gateway or the transaction, the choice for transaction by end users. Well, in this case, now that we have solved for the seamlessness, for the integration barriers and challenges that we've had previously, and we can allow for significant, substantial types of financial products to ride these very same rails, and we can get into the hands and the pockets of consumers in such a seamless manner, we find that the customer preference for working with a trusted brand, bank, that often can offer more competitive rates, but definitely has proven to be regulated, to have to conform to certain practices, ethical practices, etc. All of this together explains why so many of buy now, pay later users are preferring financing that emanates or that is provided by banks that they know and they trust. And this is really the time for banks to consider the fact that many of those obstacles that they seem to think that were in their way in the past are now able to be dealt with through the wallet. But it's a bit more than that. It's not only the enablement of the wallet, it's also the fact that today, if you are not present in the customer's wallet, then you don't exist. Customers look to transact through their wallet. And if you can connect yourself to that juncture, to that center of gravity, Ari, as you mentioned before, then you become an option. Then you can be considered by both the merchant and the consumer, because that is where they're looking to. And the wallet becomes here not only a functional component of consumer lending, but it becomes an absolutely critical marketing and disbursement component, one that cannot be ignored by players who are looking to preserve and gain market share. So in many, many ways, what has happened, what has transpired, is good for the bank. It removes many of those obstacles. It gives many more distribution options to the bank. And as we mentioned before, because it is an important distribution vehicle, if you're not there, you don't exist. You have to make sure that in one way or another, your customers can access your offerings through the wallet or utilize them through the wallet, etc. It is good for the merchant, of course. We mentioned before, this eliminates much of the integration, much of the very miserable shopping experiences that existed previously when these things were piecemeal. And of course, does not require any additional training and therefore no bottlenecks at the checkout because all of a sudden the coworker or the staff member wasn't trained on what it is that they're supposed to process or offer. And of course, good for the customer because it includes the discretion that we spoke about, the ability to access the financial product when and where they'd like to do that. It informs them of their purchase power way in advance, and essentially creates the type of experiences and enablement that we are all looking for. And then finally, sorry about that. Finally, what about B2B? So yes, I interchangeably use the terms of consumer and user and customer. And when I use the term customer, I'm looking to include far more than consumers. We today are engaged heavily, not only in enabling consumer lending for our partners, but B2B has been actually an even faster growing segment of our market, our portfolio. The question is is Apple Pay relevant to B2B? We're not going to tackle all of this just now because we just don't have sufficient time. But I will mention just 2 points that I think need to be taken into consideration. One is that at the end of the day, if we're speaking about small businesses, for example, every small business owner is a consumer. And as such, they have learned to expect certain types of experiences and certain types of abilities to transact. And the second point that I'll make is the fact that as a transactional component, it really should be agnostic as to the type of context or transaction that is being facilitated at that point. Apple Pay is another form of transaction, just like a card, a physical card is, or cash. Those are obviously used in any context, B2C and B2B, and should be treated as the same in the context of embedded lending and point of sale finance, for example. I probably have maybe a couple of disappointed people because we haven't had sufficient time to actually run into success stories, but I'll mention 2 things in 30 seconds and then leave just a few minutes for questions. The places where we have found these type of virtual cards and then the evolution into wallets to be wildly successful were situations where we needed to cater to different types of journeys. So in-store, I mentioned at length, and we really had an unbelievable success story with some of the global brands that were heavily reliant on that in-store shopping experience, being able to turn it on its head, put it in the customer's pocket in terms of discovery, in terms of discretion, and in terms of seamlessness at the point of sale, and do this across many different markets when you sometimes have to have different financial partners in each. That was pretty incredible. And the other story that we found to be enabled by virtual cards and then later wallets were actually situations where there was a manufacturer and many different types of distributors who used and operated with different types of end systems at point of sale, at terminal, et cetera, et cetera. Integration wasn't even a possibility. There were too many integrations to be had. And on the other hand, these were the type of dealerships where finance was needed more than anything else. And being able to facilitate the spend through a digital wallet that was clearly already a function that everyone knew how to process in that food chain was the silver bullet that allowed us to enable finance throughout any type of dealership, regardless of the type of system that they employed. So thank you very much for that. We have a couple of minutes for questions. So Ari,
Sure.
I'm all ears.
Okay, good. I think we'll have time for 2 questions. So Parandeep is wondering regarding the wallet itself, like how many different types of offerings can be housed there? Which types of lines of credit, revolving lines of credit, installment loans, BNPL, split pay, like what does this wallet ultimately actually look like with all those different types of offerings?
Okay, so the answer is, first of all, just straightforward. We have experience with every single one of those types of financial products in the wallet. What's interesting is that for some of them, the wallet creates additional value. So, for example, if we are if we have a partner underwriting a line of credit that is then made possible to utilize through a wallet, we then also have the ability to engage through the wallet with that end customer so that utilization takes place, so that optimization takes place. Of course, other times we just use it as a function for a one-time transaction. So although we're putting it on in the wallet, we close it out and it disappears once that initial transaction takes place. But happy to expand on that and dive a little bit deeper either offline or in a subsequent session.
Okay. I think our final question for today is from Chris, and wanted to distinguish really between the bank's offerings and the BNPL offerings that we alluded to, some of the companies in that space. And have any of the traditional banks also now come to offer their own BNPL or let's say kind of split pay offerings already in the wallet at this point?
Sure. So the answer is we've seen both. We have seen banks offer buy now, pay laters or split payment facilities, but we've seen less of that. What we've seen more of, and that's what I meant by saying both, is banks understanding that their ability to offer longer duration and higher ticket or higher underwriting products is really where they found their niche. And we're finding more and more of that as this experience becomes absolutely seamless.
Okay, good. Well, I think we're at time, unfortunately. I think we can go on here for another hour. This is, as you said, the fact that, I don't know, nearly 1 billion people are using this warrants another hour, I think, to discuss. So just want to thank everyone again for attending today's webinar. Thank you so much for the excellent questions. We got to many of them, but there's still many others that we didn't do. And as I said, we will get back to each and every one of you with a direct email to answer those questions. A recording of this webinar will be emailed to all of the registrants and also available on the GIFD website. I just want to thank everybody again for attending, and we look forward to seeing you all in future conversations.
Thank you all.